Hello students and welcome back to yet another video. And in the last video, as you all know, we have studied consumption function, the part of a fourth unit, and in this video we'll be studying saving function, right? Let's move ahead, but to understand this particular video you should have gone through the previous videos, okay? It's important to understand the concepts. I've told you again and again that it's very important to see all the videos sequentially so as to understand the further videos and the concepts, because I'll be taking name a few concepts that you should know what is the meaning of it, because I've covered those concepts in the previous videos. Okay, so let's begin. I'll be sharing my presentation with you now. Yes, welcome back again to all of you to the online lectures of Senior College or Shahu Nagar. Now, in this video, we'll be studying about saving function. Now, the concept of propensity to save or saving function. It has synonyms. They are synonyms. So what's the definition of saving? Let's understand first that what is saving. So saving is defined as the difference between disposable income and consumption, right? That means you have like salary of 10,000, right? And you are consuming from it 8,000, right? So it's a difference between your disposable income and consumption. So your 2,000 is your saving, right? So the equation is a saving is equal to disposable income minus consumption. It is S minus YC. Now what is disposable income? This concept is cleared in the last video, okay? So that's why I've told you that you should go through all these things so as to understand the concepts nicely. Okay, now let's understand this with the help of a table. Now the level of saving depends on the level of income, right? So this is what it says. So let's understand. Just observe the table carefully. It shows the relationship between income and saving. So just look at column number 3, right, of the table that shows that when income is 0 or very low, right? Income is the first column. So just observe the third column of savings. People dissave. That means they dissave. That is it is in minus. That is minus 20 crores and minus 10 crores. So they have to consume even if they are not earning or their consumption expenditure is more than their income. Like yeah, their consumption expenditure is 70 and their income is 60, right? The second row I'm talking about. So when income is 20, like 20 crore equals consumption, when income equals consumption, expenditure savings are 0. Just observe the table. That is, when income and consumption are equal, 120, 120, then saving is 0, the third row. So as income increases further by 60 crore, the savings increases by rupees 10 crores, right? The income increases from 120 to 180. So the saving increases. So it shows that as income increases, saving also increases, but by less than proportionately, of course, not at the same rate, right? So the relation between saving and income is called the propensity to save or the saving function. So it is represented by the formula S is function of Y. The saving is function of disposable income Y. So thus the saving function indicates a functional relationship between S and Y, where S is the dependent in Y is independent variable. That is, S is determined by Y. Saving is determined by income. So this relationship is based on the assumption, other things being equal, of course, which means that all influences on saving are held constant and that income and saving increase by a constant amount. That is, income increases by rupees 60 crore and saving by 10 crores as shown in table. Okay, one, you can see that The fourth row, the income increases from 120 to 180 by 60. So the saving increases from 0 to 10 crores. That's what I'm talking about. Okay. Now let's understand this with the help of a graph. Now, the propensity to save curve is shown in this figure 1, where income is taken on the horizontal axis and savings on the vertical axis, right? Now, just observe carefully what I'm saying. You observe the table carefully. The entire S curve with a definite position and slope is the propensity to save curve. Understood? So the figure shows that below point Y, savings are negative because people save. Okay, because their income is either zero or very less. So at Y, savings are zero. Above Y, savings increase with a rise in income. So the S curve is linear. It's a straight line. Why? Because the rise in income and saving is at constant rate. That is rupees 60 and rupees 10 crores respectively. Right? So the propensity to save is of two types: the average propensity to save and the marginal propensity to save. Right? So this is how the concept is explained. Now let's understand the concept marginal propensity to save. What is that? Now the marginal propensity to save, that is MPS, refers to the proportion of an aggregate raise in income that a consumer saves rather than spends on the consumption of goods and services. Now, you put differently, the MPS is the proportion of each added rupee of income that is saved rather than spent. So MPS is a component of Keynesian macroeconomic theory, and it is calculated as a change in savings divided by the change in income, or as the complement to the MPC, that is marginal propensity to consume, right? So MPS is the proportion of an increase in income, right, and gets saved instead of spent on consumption. So MPS varies by income level, of course. So MPS is typically higher at higher incomes. So MPS helps determine the Keynesian multiplier, which describes the effect of increased investment or government spending as an economic stimulus, right? Let's consider this. Suppose you receive a rupees 500 bonus with your paycheck. You suddenly have rupees 500 more in your income than you did before. So if you decide to spend rupees 400 of this marginal increase on a new business suit and save the remaining rupees 100, the marginal propensity to save is 0.2. That is, rupees 100 change is saving divided by rupees 500 change in income. So the marginal propensity to save is generally assumed to be higher for wealthy individuals than it is for the poorer individuals. You understood? So, given data on household income and household savings, economists can calculate households' MPS by their income level. So, this calculation is important because MPS is not constant. It varies with the level of income. So, typically, the higher the income, the higher the MPS, because as wealth increases, so does the ability to satisfy needs and wants, right? And so each additional dollar is less likely to go towards additional spending. You are getting my point? So, however, the possibility remains like that the consumer might alter savings and consumption habits with an increase in the pay. But naturally, what happens with increase in salary comes the ability to cover household expenses more easily, right? You can cover them more easily, allowing for more leeway to save, and you can save nicely. So, with a higher salary also comes access to goods and services that require greater expenditures, right? This may include procurement of higher end or luxury vehicles or relocation to a new pricier residence. So these also affect savings. So if your income rises, therefore it is said that it does not increase in the same proportion to rise in income, right? So it depends, because then you can your expenditure may rise depending upon your rise in income, and it might affect savings. So if economists know what consumers MPS is, they can determine how increase in government spending or investment spending will influence saving. So MPS is used to calculate the expenditures multiplied using the formula 1 divided by MPS. That is, the expenditures multiplier tells us how changes in consumers MPS influences rest of the economy. Remember, we are studying macroeconomics here, right? So with the help of this concept as a whole, it is studied for macro, and the smaller the MPS, the larger the multiplier and more economic impact a change in government spending or individual or on investment will have. So this is how the government studies and understands the pattern of MPS, the pattern of saving and investment with the help of the pattern of by the study about the individual MPS, and they apply it to the macroeconomics as a whole. Getting my point? So it's very important concept for the government to determine the saving pattern, right, of an economy. Let's understand the determinants of savings. Okay, so there are 9 determinants of savings. We'll understand them one by one. The rate and size of saving in an economy are determined by a multitude of factors. So let's find out what they are. The very first one is the level of income. As Keynes stresses, savings is basically a function of income, and saving increases with income. We all know that. So of course, there can hardly be a proportionate relationship between the size of income and savings. But empirical evidences has proved that there is a marked correlation between the two. But however, the amount of personal savings depends primarily on the disposable income. So thus, the saving income ratio, that is S divided by Y, tends to rise with an increase in income. Agree with me? So it has been observed that the is MPS is, one second. Yeah. So it has been found that MPS, that is marginal propensity to save, is change in saving divided by change in income, right? So, so MPS tends to be high in higher income group sectors of community. So indeed, in developed countries where per capita income is high, the saving income ratio is also high, right? So according to the survey, the gross domestic savings are always higher, it's higher in USA. Why? And that of India amounted to 18.6%, and that of India less than 7%. So it was found in a survey that the gross domestic saving of the people of USA is higher than India. Now that might be because of the differentiation in the level of income, right? So among modern economists, there is a difference of opinion about which concept of income to be adopted in the saving function. So there are 3 types of variants on the concept of income, that is absolute income, relative income, and permanent income, right? So this is how level of income determines saving, the first determinant of saving. The second determinant of saving is income distribution. Now, we all know that aggregate saving rate also depends upon the distribution of income and wealth in the community. Agree with me? So, if there is a greater degree of inequality of income among the people, then what will happen? That aggregate saving rate would tend to be high, as the richer section of the community has a high propensity to save. So a country with a low per capita income and a fair distribution of national income would imply a low saving rate. Getting my point? Thus, with an improvement in the distribution of income or correction of income inequalities through fiscal and other measures, the aggregate saving rate may tend to decline in the initial stage. So thus, the goal of distribution of income and wealth may come in the way of capital formation by causing a reduction in the domestic aggregate savings. So nonetheless, the ideal of just and fair income distribution cannot be sacrificed on this ground. So this is how income distribution determines these savings, right? The third one is consumption motivations. Now, what is that? Like saving is the residual part of income left after consumption. You agree with me? So, thus, to know the factors affecting savings, we must know what factors determine consumption, motivate consumption, right? So the consumption of the commodity depends upon variety of factors and motivations. The consumption pattern and its size are determined by, for example, the consumption of certain types of goods required by physically and socially generated needs of a human being. Now, these needs, of course, can be satisfied alternatively by a large number of qualitatively different kinds of goods, right? And now these different kinds of goods have qualitative variations and ranking, which form the community scale of preference. So, in fact, the pattern of consumption and its volume depends in general upon the standard of living of people, right? So, the level of saving actually achieved by anyone represents the outcome of the conflict between his desire to improve his current standard of living and his desire to obtain future welfare by saving. You getting my point? So, in this context, therefore, motivations regarding savings and consumption expenditure must be analyzed. So, to point out that usually while choosing consumption goods, what people prefer, they prefer higher quality goods to lower quality goods, right? Our psychology with a view to improve our standard of living, you know. So, a person's physical needs usually remain the same, but his social needs vary from time to time. In order to have a high quality goods, you want to buy a branded jeans rather than a local jeans. So it is not your physical need. Jeans is jeans. It fulfills your physical need. Whether you buy a Lee jeans or a Nike jeans, or you buy a normal local shop jeans, but your social needs to be fulfilled. You want to flaunt the brand. You understanding? Getting my point? So the social needs of a person depend upon his age, his occupation, social position, and the status. So the consumption of certain goods, especially the articles like is caused by maintenance of self-esteem or the acquisition of prestige. In the society where there is a system of differential social status, there is a vital determinant of this becomes a vital determinant of consumption expenditure, and that motivates them to consume the high cost goods, right? And branded goods to fulfill these needs. So in short, what I'm trying to say is the consumption pattern of a person is based on his budget constraint and the desire to save. However, any rational balance in consumption decision is far from frequent, right? So this is how consumption motivation determines saving. I hope you understood this concept. The next one, the fourth one is wealth. Now, holding of wealth or liquid assets by a person, it also affects consumption decisions. So out of different income, a person would consume more and save less if he possesses adequate amount of liquid assets like cash, bank deposits. I hope you understand by you have studied in accounts what are liquid assets that can be converted into cash within a year, and feels that his life is in future is secured. If he feels that he's enough cash balance and bank balance, he feels secured. So similarly, an appreciation in the value of financial assets would also induce the person to consume and save less. Okay, so this is how the wealth affects saving habits. Now, next is of course habits determine savings. Now, how? Habit is a very major determinant of your consumption pattern, remember. As a matter of fact, at any one moment, a consumer already has a well-established set of consumption habits. Just think about yourself. Do you have a well-set, established set of consumption habits? The habit of consumption in the form of taste. You want to eat food of only this hotel, even if it is costly. Likings, fashions, I just discussed the jeans example, and other psychological influences on the minds of consumers. So, by nature of his habit, when a person is a spendthrift, his savings will be relatively less out of the given income than that a person who considers saving as a virtue, of course. So, thus, aggregate saving in an economy depends upon the types of habits of the people in general in the economy. Getting my point? So, habit conforms of the standard of living of the community. So habit in the long run may not be a very constant factor, of course. It is subject to change depending on the change in the environment and society. So in general, people want to improve their standard of living by improving the quality of goods they consume, of course. Like public policies are also devised to improve the living standards of the masses. So with the increase in income or otherwise through this saving, there may be drive to spend more on superior goods. This is there is always a psychological impact of superior effectiveness of certain goods, such as comfort, convenience, beauty. You want to have a cosmetics of the best brand. Maybe it is costly. You want to buy a Mac and not go for Lakme. Why? Because Mac is of a high quality. It is about your skin. It's about your beauty. So, which induces people to spend more and save less in due course of time. Right? You understood this point? The how the habit influences. So, it has been observed that when people habitually use one set of goods, they tend to be dissatisfied if there is a demonstration of superior consumption by others, right? So the poor countries are saving deficient. Their problem of low saving rate is further accentuated by the desires to imitate the superior consumption standards of developed nations induced by international demonstration effect, right? So a study does this also in demand, remember. So the next determinant is, of course, population. Higher growth of population, of course, has an adverse effect on the per capita income, which causes, of course, an adverse effect on the saving income ratio. Agree? So again, the age distribution of the population also affects the volume of aggregate saving in the economy. Now, uh, aggregate personal saving depends upon this saving of old, retired people and saving of the younger group. So a community's aggregate savings would be zero when the positive saving of the young people is just balanced off by the dis-saving of the retired people to maintain their consumption expenses, right? So if a society has a large proportion of young people in relation to old, then net aggregate saving will be positive. So thus the aggregate saving ratio in the community tends to vary with the age structure in the population, right? It follows thus that when the population is stable in all respects, of course net savings will rise with the increasing per capita income in an economy, right? The next is objective and influential factors. Now, there are a number of objective factors, mostly institutional by nature, like which affect the capacity and willingness to save of the people at large. Now, for example, political stability and security of life and property encourage people to save more. So, similarly, the existence of a good banking system and other developed financial institutions of money and capital markets, such as life insurance, financial houses, like shares of good corporations, like government bonds, securities, this induce people to save more under the economies of interest earning motive by providing a wide range of remunerative investment opportunities. Understand? Also, this taxation structure And the fiscal policy affects savings in the economy. So a vigorously progressive direct taxation leads to a reduction in voluntary personal saving. You're burdened, right? So similarly, higher the widespread indirect taxes will force the consumer to spend more on maintaining his given standard of living. This will cause reduction in saving because he's paying away his income, is the portion of income in taxes. So similarly, his corporate taxation will reduce the net profit of business houses and curb their capacity to save. So this is how the institutional factors affect savings, right? So on the other hand, certain concessions provided in the taxation schemes can help promoting the voluntary savings, like for example, exemption of interest earnings up to rupees 3,000 a year from bank deposits, like outright deductions of life insurance premium, contribution to provident fund, etc., up to rupees 5,000, whatever, serve to stimulate saving. People are motivated to save. So price stability or check on inflation by governmental efforts can also sustain savings, while hyperinflation may lead to saving or reduction in saving. So likewise, windfall gain and losses also affect savings, of course. So the former will lead to rise in saving and the latter will induce this saving, right? So this is how about the objective. Let's understand subjective motivations for savings. Now, what is that? People are induced to save more when they are strong subjective factors which motivate them to save. Like keenness enlisted the few main motives which lead individuals to save. Like the very first one is precaution, that is to build up a reserve against unforeseen contingencies. You save, right? You may have a foresight to provide a future need, a daughter's wedding or children education or buying a house, or you might have you want to enjoy or other calculation of interest, that is to enjoy interest in a larger real consumption at future date. You calculate that if you save this much interest will be received in so many years. So this is how that also is a subjective factor. The next is improvement in the standard of living gradually, because if you save you can live better life in the future. Next can be independence, that is to enjoy a sense of independence and the power to do things with accumulated savings. Now if you are saved for 5 6 years, and at the end of 6 years you've received a good bulk amount, and then you can do something with it. You can buy some item with it. You wanted to buy a fridge always, or you wanted to buy a car always, or you wanted to buy a house. So it depends. So this is how you achieve independence. The next can be enterprise, that is made to make speculations or undertake business projects. You might want to expand your business to satisfy your like pride, right? So these are all likewise savings of business firms are induced by the following motives. Like I've told you before, these precautions, foresight, calculation, improvements, independence, enterprise, pride. These are some individual motivate individuals to save. So what are the savings of business firms that induce? What are the motives? So for business firms, the motivation factor would be enterprise to carry out further capital investment. They might have a good capital through invest in some business or to expand the business. The next can be liquidity. They can have a liquidity in hand in case of any emergencies of the business. The next can be improvement or to expand the business. And the last can be prudence, that is to have financial prudence in discharging debts. So this can be a subjective motives for the business enterprises. So here in this, we studied subjective motives for individuals as well as for business firms. The last one that determines savings is rate of interest. Now, according to classical economists, saving is the direct function of rate of interest. So to put it symbolically, it is S is function of I. That is, savings is function of interest. It suggests that savings tends to rise with an increase in the rate of interest and vice versa. Do you agree? If you save more, if you find out that interest is more, right? So Keynes, however, did not agree with this view. He asserted that savings is a function of income. There are different views, but in classical theory, it is of a view that rate of interest, of course, determines savings, and we also individual think that somehow at particular proportion it determines savings, right? So, but it remains a fact that the personal saving of some individuals who are motivated by economic considerations is certainly induced to save more when rate of interest rises. So they may be willing to curtail their consumption and try to earn more income in order to save more, right, and earn more interest. So of course, both are important in interest and income, because if there's no rise in income, they can't save. So, but a mere rise in rate of interest is not enough. Of course, income must also rise. So they both go together. Okay. So, income is the basic determinant of one's capacity to save. It is the basic determinant. Now, saving comes out of income and not from rate of interest. But a high rate of interest induces them psychologically. It pushes them psychologically to save. Who might not be thinking of saving might think of saving, because if he is having a disposable, like the difference between the disposable income and consumption is there, he's having some amount to save, then he might think of saving if interest rate is high. So interest rate would induce him to save. That is the point. So it's stated, however, rate of interest is an important factor in the mobilization of saving. So people would be induced to pass on their savings to those institutions which offer a high rate of interest. Thus, from the point of view of holding of near money asset, the rate of interest constitutes a significant factor, significant influence. Agree? So a person would like to keep his saving in that type of bond from which the relative yields will be highest as against any other type available. Right? It's a human common nature that we think about. Okay. So this ends our determinants of saving, all 9 concepts. Now let's move further and understand the relationship between consumption and saving function. That is relationship between MPC and MPS. So what you've studied till now, like historically, consumer demand and consumption have helped drive the economy. So when consumers have a greater amount of extra income, they might spend a portion of it, thereby spurring growth in the economy, right? So consumers might also save a portion of their extra income. So these tendencies aren't mere observations, but are the basis for the MPS and the MPC. How? The MPS is the portion of extra rupee of a household income that's saved, and MPC is a portion of each extra rupee of a household income that is spent. So the sum of MPC and MPS is equal to 1. For example, suppose a man's income increases by rupees 1, and if out of it he spends 70 paisa on consumption, then MPC is 0.7 and saves 30 paisa, 0.3. So MPC and MPS is 0.7 plus 0.3 is equal to 1. Agree? Okay. So since MPS is measured as a ratio of change in saving to change in income, its value lies between 0 and 1. Also, MPS is opposite to MPC, right? So mathematically, in a closed economy, MPS plus MPC is always equal to 1, since an increase in 1 unit of income will be either consumed or saved. So we know that income is either spent on consumption or saved. Symbolically, by income is equal to C plus S. Now, clearly, if 1 is given, we can find out the other, because the sum of MPS and MPC is equal to 1. That is incremental additional income. So MPC or MPS cannot be negative, because MPS is ratio between additional savings and additional income, and similarly MPC is ratio between additional consumption and additional income. Hereby additional shows positive value, so it can never be negative, right? So as saving is a complement of consumption, the MPS reflects key aspects of a household activity and its consumption habits. Now, it is expressed as a percentage. Like for example, if the marginal propensity to save is 10%, it means that out of each additional rupee earned, 10 paisa is saved, right? So the marginal propensity to save is calculated by dividing what? The change in savings by the change in income. So for example, if a consumer saves 20 paisa for every 1 rupee increase in income, the MPC would be 0.20. That is 20%. Understand? That is 0.20 divided by 1, 20%. So MPS reflects the savings amount or leakage of income from the economy. Now, what is leakage? Is the leakage? Leakage is the portion of income that's not put back into the economy through purchase of goods or services. So the higher the income of an individual, the higher the MPS, as the ability to satisfy needs increases with income. So in other words, each additional rupee is less likely to be spent as an individual becomes wealthier. So studying MPS helps economists determine how wage growth might influence savings, right? So the MPC is the flip side of MPS. So MPC helps to quantify the relationship between income and consumption. So MPC is the proportion of each extra rupee of a household income that is consumed or spent. For example, if the MPC is 45% out of each additional rupee earned, 45 paisa is spent. So economic theory tends to support that as income increases, so too does spending and consumption, of course. So MPC measures the relationship to determine how much spending increases for each rupee of additional income. So MPC is important because it varies at different income levels and is lowest for higher income households. So the MPC is calculated by dividing the change in spending by change in income. Like for example, if consumer spends 80 paisa for every 1 rupee increase in income, the MPC would be 0.80 or 80%. How 80%? 0.80 divided by 1 into 100. So this is how it is calculated. So the MPC, like the MPS, affects the multiplier process and affects the magnitude of expenditure and tax multipliers. So ultimately, both MPS and MPC are used to discuss how a household utilizes its surplus income, whether that income is saved or spent. So consumer behavior concerning savings or spending has a very significant impact on the economy as a whole. So I hope you've understood this concept, that is the saving function and relationship between MPS and MPC. So this ends our unit, and we'll be continuing the next part in the next video. Till then, watch the video and study hard. Thank you.